The World Bank and IMF have mastered the art of coercion. They don't need to send in armies. They simply restructure economies to serve their interests. John Perkins.
The World Bank, the IMF, the BIS, the OECD. When you hear these terms, what do you think? Do you think shady backroom dealings that impoverish developed countries, or international financial institutions which maintain the stability of the liberal international order? Welcome to Analyzing Finance with Nick. Today we are going to discuss these major international financial institutions, what they are, what's their history, and what role do they serve in maintaining the stability of the global economy. Let's first start with the BIS. The BIS is the Bank for International Settlements. It's the oldest of these institutions. It was started in 1930 as a response to handling the payment of reparation debts that were accrued as a result of World War. The resulting mismanagement of paying these reparations led to major central bank catastrophes and balance of payment imbalances, and especially since this was a time that the gold standard mostly held, you saw the volatility of global gold flows causing a lot of economic turmoil, most notably in Britain, France, and in Germany, which had the Weimar hyperinflation and experienced the worst of the financial volatility that was during the interwar period. If you want to learn more about the financial volatility of the interwar period, the gold flows, and how central banks kind of handled this, and often badly handled this time, you should read a book called Lords of Finance, which I've recommended before on this channel, that goes more deep into the era that shaped the formation of the BIS. And really what the BIS does today is that it's the bank of central banks. Like, it kind of sets all of the rules for central banks. It facilitates monetary transactions globally and helps manage reserves. It provides a forum for central banks to collaborate on policy, and it conducts research on economic and financial stability issues. They have like subcommittees within the BIS, which technically do not fall under the BIS's mandate, but have a regulatory power over the private banking organizations in the world. This is known as the Basel Committee on Banking Supervision. And you see like regulatory proposals such as Basel I, Basel II, Basel III. These are a collection of agreed upon regulatory solutions for the banking system to prevent financial instability. And these are not necessarily hard laws made by the BIS, but governments around the world often mandate banks to cooperate with the Basel framework proposed in these by the Basel Committee on Banking Supervision. It's kind of like when you have Catholic Vatican councils that set the rules of the Catholic Church. The churches all over the world kind of fall in line, even if they're not under the jurisdiction directly of the Vatican. Whereas like Vatican II or the Council of Trent, like the closest thing to that in the world of finance is the Bank of International Settlements and the Basel Committee. The main criticism of the BIS is that it tends to be structurally biased to favor Europe. It was pretty much entirely a European-dominated organization until it globalized in the 21st century. And now basically every major central bank in the world is a member of the Bank of International Settlements. The other criticism is that it's a private organization and it's not really controlled by any government, yet this private group is essentially setting the rules for everybody else in the banking system and the central banks, which apparently are supposed to be working at the interests of the people. And then based on the fact that the regulations are named Basel, you can assume that the BIS is headquartered in Basel, Switzerland, which is basically considered neutral territory, yet a financially sound place. So that's kind of why the central banks in Europe and the people who founded the BIS decided to set it up there. The next one we're going to be talking about is the World Bank, along with the IMF, were founded during the Bretton Woods Agreement in 1944 as organizations to help facilitate the new post-World War economy. The World Bank's goal on paper is to reduce global poverty and foster sustainable development for lower and middle income countries. And the way they do this is they provide loans, grants, and technocratic expertise, mainly in economic policy, to help develop infrastructure, improve healthcare outcomes, and they want just to have sustainable long-term economic development to help these countries grow. And then the main criticism for the World Bank is that they don't do this just out of the kindness of their hearts. There are a lot of strings attached to World Bank loans. Example would be is that they often demand privatization of state-owned businesses as part of the deal of the government taking the loan. They could often sometimes demand fiscal austerity measures. They can also force certain political outcomes like trade deals or diplomatic relations with certain countries, mainly the United States, and force liberal international order standards on how to govern your country. A lot of authoritarian countries, money from the World Bank, then you have to listen to the US's standards, and often it means your political power is at stake. China has come in as an alternative to the World Bank for a lot of developing countries who feel like if they do a deal with the World Bank that they would be losing their sovereignty. And China, what they do is they agree not to interfere with your domestic politics or recommend any policy changes whatsoever. But in exchange, if you don't pay your loans, you are required to pay the Chinese government through the natural resources that you have, that the Chinese government financed you building the infrastructure to extract more efficiently. So this is a way that China can get natural resources on the cheap through issuing these loans that they know cannot be paid back. And in the book by John Perkins, I mentioned a lot of times in this YouTube channel, is called Confessions of an Economic Hitman. And it discusses how the World Bank does something similar, except instead of trying to extract natural resources, the conditions that the World Bank puts on their loans is required policy changes or required permissions for multinational corporations, often from the US, to be able to have a disproportionate power or be able to maintain or expand their business operations in their country. And so they do something similar. They will lend to governments an amount that they cannot pay back sustainably. And then as part of the default, you have to agree to the terms that the World Bank requires you to do in exchange for forgiveness of those loans, or just delaying the payback, like extending the maturities or other ways to restructure the debt. The World Bank is more initiating new development, whereas the IMF is the lender of last resort for the world. It was also started as part of the Bretton Woods Agreement, and again, it has a similar story. It wants to reduce poverty and have global financial stability and facilitate trade, but instead of being the organization that helps kickstart countries' economic development and helps them finance infrastructure, what the IMF does is if a country gets in trouble, they go in and say, hey, look, we'll offer you a bailout. We'll help keep your currency stable, because that's what originally was intended to do, because every country was on the Bretton Woods gold standard, where every currency in the world had a fixed exchange rate to the dollar, but the dollar had a fixed exchange rate to gold. And when a country had fiscal or monetary problems, they would be at risk of their peg breaking, and that would destabilize the Bretton Woods system. And the way that you get around that is the IMF could come in and help you out and shore up your reserve problem in exchange of policy concessions. Even now in a fiat world post-1971, the IMF still has that role as a backstop, but instead of their goal being to maintain the value in a gold standard world, is to stabilize the country. If there is a hyperinflation problem, put it to a stop, but balance their balance of payments and their fiscal situation, that they can be a viable trade partner in the global economy and not be in perpetual crisis. However, like the World Bank, the IMF has a lot of strings attached for their short-term support and helping you out of your crises. It often requires that countries have to pass extreme austerity measures in the form of cutting social benefits, raising taxes, things that will hurt the economy in the short term and is very politically painful for incumbent governments and democratic democracies. So it's not very well liked upon people who take loans from the IMF, because there's usually a lot of pain that results in taking a loan from the IMF. And some of these countries are mismanaged, and they kind of need to accept this pain and they won't accept this pain in any other condition other than in exchange for IMF bailout funding. However, it doesn't mean it's politically popular to accept any sort of austerity. The other thing that it does is it could exacerbate income inequality, because a lot of the things that are victims of the IMF policies are social programs for the poor or other government activities that help move people up out of the bottom classes into the middle classes. And also there's usually sometimes currency devaluation, which is a byproduct of IMF. More recent examples of austerity and painful measures that countries went through because of IMF bailouts include what happened to South Korea in the late 1990s, Greece in the 2010s, and most recently, the perpetual economic crisis that is in Egypt. So the World Bank helps development. The IMF bails countries out when they're in trouble, but they both have very strong strings attached, and they usually generally require you to conform your economic policy and your governmental structures to be in line with what the liberal international order wants. So countries outside of the order and more authoritarian regimes will more likely take deals from China or Russia or other alternative means of financial support than going through these international financial institutions, because it's a threat for them to accept those kind of payments because of the strings attached. The last organization is technically not international financial institution, but it's kind of in line with a lot of these other organizations, and that is the Organization of Economic Cooperation and Development, or more commonly known as the OECD. And the OECD really has two purposes. One, it's kind of a proxy of becoming a developed nation. If you make it into the OECD, that is kind of a sign that you are no longer an emerging market country and that you are truly one of the developed market economies. And even though some emerging market countries such as Mexico and Turkey are in the OECD, it's kind of an exclusive rich countries club that is kind of a sign of national prestige if your country is in the OECD. But it's not a bank like the other organizations, and it's not really restricted to like lending and the banking system. It's more a policy think tank. It conducts research and provides policy recommendations on a variety of economic issues, mostly things such as taxation, education, healthcare, and environmental sustainability. Most notable recent example is their proposal of a global minimum tax to prevent tax arbitrage across developed countries for corporate income taxes. They try to set international standards and guidelines for other OECD countries to follow and set the benchmark. And it's a place where economists from all of these countries can collaborate and discuss ideas. The main criticism of them is that they are kind of exclusive and elitist, and their priorities are mainly to benefit themselves meaning the other wealthy nations, at the expense of developing countries. It's also an arm of the liberal international order in a way, and it kind of enforces conformity to what the goals of the liberal international order are. So if your country, no matter how wealthy it is, doesn't really want to comply with those, it's not going to get very high marks from the OECD. So overall, these institutions are very important for preserving the liberal international order, whether it's maintaining trade, whether it's stabilizing economies to prevent these countries from becoming failed states, or whether it's to help encourage development for developing nations, or to help set the economic and financial standards to maintain stability in the wealthier nations. All four of these organizations are involved in this, and they're all questioned for their effectiveness and whether they really are trying to work in the best interest of the global economy and for individual countries, or they're really just the enforcement arms for the United States and the liberal international order's interests and goals overseas. Let me know what your thoughts are on this. Do you think that these organizations have done a net good for the global economy or a net bad for the global economy? Would you like me to go deeper dive into these organizations? And is there any other international financial or economic organizations that you want me to explain in a better and easier way for you to understand? And feel free to like, subscribe, and share. Your support helping growing this channel has been crucial, and I hope you learned a lot from today's video lesson. Thank you for watching.